All of you. Welcome to the Hexaware conference call. From Hexaware, we have with us Mr. R. Srikrishna, CEO and Executive Director, Mr. Ashok Harris, President, Global Delivery, and Mr. Rajesh Kanani, Chief Financial Officer. The Safe Harbor statement is available on the Hexaware website, and I shall take that as read. I have sent out the results a couple of minutes back, and we'll run you through a presentation which will be coming up in our website in a minute or two. So with that, over to you, Keith.
Good evening, everyone. I want to start by apologizing for the fact that our results went out much later than what we had planned to. There's some issues. They're behind us now, but it still went out later than we planned. So I apologize if you've not had enough time to see it. We will try and walk you through it as best as we can. You can follow it along if you log into the WebEx online. There are some of you online, but those of you who are not there, you may want to consider doing it, especially if you've not seen the results so far. We are going to take slightly longer than usual in the initial commentary. And we will go over a few minutes additional if required on Q&A because we want to cover the usual quarterly commentary, but we also want to provide both a full year view for 2017 and also guidance for 2018. With that, on our Q4, we had, we've been guiding that for a while that we're going to have two client issues because of which we're going to have a soft quarter. And actually, what I've been telling all of you now for 2 quarters is that notwithstanding the two clients, we are likely to get close to double-digit Y&Y growth. The fact is actually we did better than that quite a bit. So we are at 12.3% Y&Y growth. A small quarter-on-quarter growth, which actually any quarter-on-quarter growth, given some of the issues in this quarter, is great. And the fact is then we have a small quarter-on-quarter growth and a reasonably good Y&Y growth, which puts us in a good spot for 2018. Our EBITDA is down from the previous quarter, but again, Q3 is always a bit of a high point in each of our years. We always like to talk about EBITDA and like you to think about EBITDA on a full year basis. Again, we'll talk about guidance versus actuals. We provided an updated guidance on EBITDA for the full year. And if you do the numbers, you will see that ultimately our EBITDA for the full year is going to be even higher than the higher end of the guidance we provided in the end. And we believe likewise, while we did not provide guidance on PAT and EPS, you will see that the numbers, based on the EBITDA, should have been better than what we guided for. One note on the PAT, that this quarter there was a little over $1 million one-off negative impact on tax as a result of a write-off due to the U.S. tax law change. So we had forward tax at over 41% ETR, which is now expected to be down to about 26% or so. So we wrote off, actually the write-off was more than that, but there were some additional positive one-offs. So net of that, there was still over $1 million one-off negative impact in the PAT in this quarter. All of our, vast majority of our growth in the quarter came through volume increase. There was a little bit of improvement in price realization. Our margins, the majority of impact in margins were as a result of 3 factors. Calendar, Q4 was lower than Q1. Q4 lower than Q3. we had wage increases, so a full quarter of wage increases plus onshore wage increases. There was also kind of H-1B wage corrections that we did. So essentially, it's another form of wage increase. So essentially, the full impact of wage increases. And thirdly, there's a number of deals that were signed in Q3 and some that got signed in early stages of Q4 for which there were startup investments, and some of those startup investments took the form of third-party costs and bringing in some consulting type work, which led to a higher than usual cost in that area. So those were the three areas that led to, which contributed to the margin difference between Q3 and Q4. There's, as in every quarter on an annualized basis, there is a healthy kind of churn in the top 20. And again, with the exception of two clients that I'll speak about more, all of the rest of this churn is as a result of growth in all customers. There's nobody who's going down. And so, except the two that I've already referred to, the churn is extremely healthy. We're seeing new clients growing and getting into the top 20. So I have the pyramid up here for those of you that are seeing it on the WebEx, and it's on slide number 9. I'm sorry, slide number 8 for those of you seeing it offline. So I want to spend a few minutes here. First is the pyramid itself. This is a full year view. What we present each quarter is an LTM for the quarter. So LTM for this quarter then basically means the full year view. So there's a full year view of FY16 versus FY17. You go from bottom up, you just see an improvement at every level. It shows we've added customers, 10 customers in the greater than 1 million range. A good number of them are above 5 million. So, 7 of those 10 are in the above, the 1 to 5 million range. One has already gone into the 5 to 10. So there's, consistent addition at each level. The 10 to 20 has gone up by 3. Usually and 1 is reduced from the 20 to 30, but the 10 to 20 has gone up by 3, right? So we feel very good about how our pyramid is shaping up, and you see that reflected then in our growth numbers for client buckets, right? So look at our top 5 clients for this quarter was flat. Grew at 0.1%, and that's actually a very good outcome, given that one of our top 5 clients, we spoke about the project that we lost. The transition got completed in Q4. So we lost a ton of revenue from that client in this quarter. Notwithstanding that, the top 5 clients are flat. The next 5 clients grew at 8% quarterly, and actually they more than doubled on a Y&Y basis, 100+% Y&Y growth in the next 5 clients. And the next 10 clients actually contracted minus 10% almost. But that's again due to a single client. So if you recall, at the beginning of the year, we said there are 2 top 5 clients. Now, out of that 2, one of them still remains in the top 5. Even in Q3, the other client had come down to between 11 and 20. They were no longer in the top 5. And so that 11 and 20 is now, is out of 11 and 20. It's virtually gone to 0, that client. Very small revenues left. So that's the primary reason. And actually, if you disregard that single client, the 11 to 20, 9 clients in 11 to 20 grew at about 6.5–7% Q on Q. We won $72 million of NN, new clients this quarter, which takes our total annual booking to $180 million. Only from NN clients, I want to clarify, this does not include new bookings or renewal bookings from existing clients. This is all only new bookings from new clients. The equivalent number in FY16 was 154 or 155 million. So it represents close to 18% growth in that number, which is kind of consistent with, what we need to achieve an aggressive growth number for 2018 as well. I will call out 2 or 3 deals. There were 5 significant deals in the quarter. I'll call out 2 or 3. One is actually the biggest lot of this is actually a client that we announced last quarter, which is a global imaging technology provider, printer company. They actually signed last quarter, but there was a smallish, pilotish type of deal. There was a much broader commitment made in Q4 from that client. A vast majority, it's a basket of work that includes run and change, but the majority of the work is in transformation and change. The second one that I will call out is a multi-year BPO deal. This is to, this client provides a variety of back office services, finance, accounting, payroll, tax kind of work for customers in many countries. In each country, they have many offices that do it differently. Each country certainly does it differently, uses different platforms. And what we've signed up with them to do is to bring commonality, harmonization of processes across all countries, and then bring in substantial level of automation. Our employee metrics continue to remain positive. Our attrition trended down further to just over 13%. Our utilization, inched up just a tad. Again, it is our intention to continue to try and bring it down a little bit from where it is today, because we think it will help us fulfill demand better. For the quarter, the headline of growth from a geography perspective was Europe, but Europe was only just marginally ahead of APAC. They were both, one was at 8.2%, one was at 8.1%. APAC, contributes, their Y&Y growth is like 79%, so they're almost doubling. And Europe has a pretty healthy Y&Y growth to a 22%, 23%. But the good news is that, we've set an objective for ourselves that in 3 years, we want contribution from outside US, US contribution to come down to 70%. About a year ago, if you recall, a year and a half ago, it was 82% was US. For Q4, US is down to about 78%. And APAC and Europe contribute 22%, and we expect that trend to continue, which we see as very positive. From a vertical perspective, this quarter, again, BFS led growth, which is very consistent. H&I had a pretty robust quarter too. And from a horizontal perspective, IMS continues to lead growth, and followed by BPS. And the third is ADM. And this 3 has been pretty consistent for us for a number of quarters now. With that, I'm going to shift and provide some additional commentary that we don't normally do on a full year basis. I'll take 2 or 3 minutes on this, right? So for a full year, again, you can see this if you're looking at it offline on slide number 13. For the full year, our revenues grew at 15.6%. I want to jog your memory that at the beginning of the year, we provided a guidance of 10 to 12% growth. In the middle of the year, we upped that to 14 to 15% growth. And at the end of third quarter, we said we will grow at the upper end of this 14 to 15%. And finally, what we have is 15.5, 15.6%, considerably above the upper end of the guidance that we provided. Likewise, EBITDA we initially started by saying it will be in line with revenue growth, which means 10 to 12%. When we upped the revenue to 14 to 15%, we didn't change it. But in Q3, we said that the EBITDA post ESOP will grow 16.5 to 17.5%. And what we did ultimately is 17.8% growth post ESOP, which is again comfortably above the upper end of the guidance, the multiple times revised guidance that we provided. Finally, we had some solid forex gains during the year, and we improved our ETR as the year went on. So our PAT, percentage improved, and our EPS ultimately grew at 20.5% for the year. The vast majority of the year growth, out of the 15.6%, 16.1% was volume growth, and there was less than 0.5% contraction due to forex and price. So ultimately, price held largely stable, and there was very healthy volume growth during the year that contributed to almost all of the growth. We told you a little bit about where what geographies, horizontals, and verticals led growth for Q4. Those exact same, those hold true from a full year perspective too. From a full year perspective, APAC led growth. In Q4, APAC and Europe were on par, but for the full year, APAC clearly, 56% growth for the year. For the full year, BFS delivered 23% growth, followed by MNC and others was 12, a little over 12. H&I was a little under 12. And from a horizontal perspective, for the full year, the top three remain IMS, BPO, and ADM in that order. Right? During the year, there are two other things that we would like to call out, which are very significant. The first is that every year now, for the past 4 years, since I've come, this is the fourth year, we hired an external agency to do customer satisfaction survey. And the same company does it for about, 40 other IT services companies globally. And so they provide us with a benchmark. And, if you're seeing the chart, you'll see a trend line of past 4 years scores. They've improved every year. But really, what is of importance is that the 2018 really scores for 2017 that get presented in early 2018. The scores you see in 2018 are they represent industry highest in every category. So if you're seeing the chart, you'll see a chart on the right side of this, on slide 17, where for each metric, loyalty, advocacy, satisfaction, value for money, you see the industry highs and the industry low. In each metric, in all 4 metrics, and at the bottom, you'll see the aggregate score. In all 5 metrics, Hexaware score represents industry high scores for customer satisfaction. This is something that we are very, very, very proud about. Now, this improvement in operational performance did not come by harvesting the business. We actually made substantial investments in the business through the year. And actually, we added 10 people in the leadership level during 2017. For those of you that were there in our analyst meet in August, you would have met some of them. So we have a CTO that joined us during the year. We have a new vertical head in MNC, a newly formed vertical in professional services, a head for that, a new head for enterprise services, global delivery heads for each vertical. That was not a role we had before. That was an additional role we created. So there were substantial investments that we made across the board, and we think that positions us well for sustained performance in the future. Last topic I want to touch on before talking about guidance for 2018 is that there is an evolution of our Shrink IT Grow Digital strategy. In the course of next few weeks, I'm going to be meeting some of you in person. I'm happy to meet, any and all that want to. And my primary objective in those sessions is to explain the strategy and structure in some detail. What I will do for now is simply to talk about the highest end of the strategy. So in future, what Hexaware will stand for is only 3 services. What we will do is 3 things. One is to automate everything, help enterprises automate everything front to back, starting from customer experience down to technology. This is a next step to our Shrink IT. Shrink IT, we thought about it in technology silos, automate everything. We'll think about it enterprise-wide, but also then incorporate far more of machine learning and AI technologies than we currently do. So automate everything is the first service. The second service is cloudify everything. We will help customers. We think the cloud journey is another at least 5 years more, if not longer. And to help customers sort through thinking between what to go on IaaS, what to go on SaaS, what to build for cloud, what new capabilities do you directly consume off the cloud through APIs. So thinking that through and architecting a cloudify everything journey for our customers is the second thing. The third is to help customers transform how they interact with their customers. This is how we've always defined digital, but there's a number of services that we've added, and there is a new leader we've hired who's not on this chart because he's joining us next week. We'll actually make an announcement next week when he joins us. So we are very excited about the strategy. We think this will represent our journey for the next several years. It is very rooted in what we do currently. The customer experience transformation is our current Go Digital strategy. Our Shrink IT, automate everything is an evolution of our Shrink IT strategy, is the next step. When we do cloudify everything in different silos today, we're bringing that together into cloudify everything. With that, I'm going to provide some guidance on 2018. For those of you that are seeing the slides offline, so slide 20, we are starting the year with a revenue and EPS growth of 10 to 12%. I do want to go back for a second to 2018. Our full year EPS for 2017, our full year EPS for 2017 is 16.82. And 16.6 diluted. Fully diluted 16.82 is pre-dilution. Fully diluted is 16.6. So we are saying we will have a revenue and an EPS growth of 10 to 12%. We're making life easy for you by talking about EPS guidance. There are things that are happening before that, some positive, some negative. We do have some positive impact of the US tax reforms. While Q4 was a negative, but that's a one-off. Going forward, it will be positive. We've not, there are some small negatives from the Indian budget, but net of it, it's still going to be positive. We think it will be positive for a number of years for us. However, we will have a little bit lower than 2017 Forex gains, so they're going to cancel each other a little bit. So, but we're making it easy for you. We're giving you an EPS guidance. Capital return, Our goal is to return 8 rupees per share for the year. So we are currently at 1 rupee dividend per quarter per share, and that's what we announced for Q4 also as an interim. For 2018, we want to actually double that return. We will kind of make up our mind between dividend and if we can do buyback. If there is a likely buyback, we will consider the appropriate mix between the two and announce the mix between the two in Q1. But the goal will be that we will return 8 rupees a share during the year. Majority of our growth for 2018 will again happen in Q2 and Q3. Now, I do want to call out that, we said this in 2016. We did not say this in 2017. We did not say it in 2017 because in 2017, the calendar across the quarters were flat. There was no difference in calendar, very minor or insignificant differences in quarter 1 to quarter 2 to quarter 3 to quarter 4. That is not the case in 2018. So again, there are quarter differences that will lead to important differences, material differences. So it will again be a little bit of a hat shape of growth, and the good chunk of the growth will come in Q2 and Q3. There's also the fact that we had a very robust Q4 in terms of deal signing. So that ramp up also will, happen through Q1 and Q2, which leads to then revenue improvement in Q2 and Q3. That's it in the guidance. I'm going to turn it over to Rajesh for a few minutes on other financial matter updates.
Yeah. Thank you, Keech. I will start with the finance update. I will start with revenue. I think 2017 full year revenue, we have a growth, CC revenue growth of 15.3% YOY for the year. Dollar revenue, we had a growth of 15.6% YOY for the year. And rupee revenue, we had growth of 11.5% YOY. Only look at quarter 4, sir, 2017, as Keith said, CC growth we had YOY, CC growth was 1.3% and 10.9% YOY. And dollar revenue 1.3 and 12.3 YOY. Now I'll come to outstanding hedge position and rates. If you see our slide 23, USD INR we had 152.88 million hedge with average rate of 70.98, almost 71. Euro INR 3.9 at a rate of 18.26. And GBP INR 7.5 million and the rate at 91.87. If we look at the forex gain and loss, I think as we have quarter 4, we had a gain of $1.98 million. Quarter 1 and 2, we anticipate 2.24 and 2.23 million gain at an exchange rate of 63.875. On the balance sheet updates, we had a cash and cash equivalents of $86.4 million in rupee terms, 552 crores or 5521 million. DSO again, we are at 49 days in Q4 and with unbilled 71 days. Dividend we have, as Keech has disclosed, we are having 1 rupee per share, and dividend payout will be 5.6 million in dollar terms and 35 crore or 57 million in rupee terms. Tax ETR for the quarter is 22.9% versus 8.9% in quarter 3. As Keith said, there was a one-time increase due to tax reforms in US, and then we had ESOP credits and losses from RT. That's how the ETR has increased. The underlying ETR is 20.5, and the capex in the current quarter, that is in Q4, October to December quarter, is 1.92 million spent. So YTD spend is 14.5 million for the full year. With that, I will hand over for question answer session.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue and your questions have been answered, you may enter star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please enter star and 1. We have the first question from the line of Madhu Babu from Prabhudas Lilladher. Please go ahead.
So, the guidance, does that imply some conservatism? And second, are we hinting at a softer 1Q?
So guidance, listen, I mean, we've shown you our history on 2017 guidance, right? The last thing I want to do is to ever reduce guidance. So however you want to take that, you can. But my philosophy is we provide guidance that there is no circumstance unless like there are, completely unknown events that can happen. But outside that, we should never be in a position to go down on guidance, right? Or have to reduce it or backtrack on it. That's my philosophy. We're not, hinting at a soft Q1. I mean, I'm just telling you that this growth, the majority will happen in, so yes, Q1 growth will be smaller than, let's say, last year Q1 growth, because last year Q1 calendar was actually pretty strong, and this year it's not. So Q2 will see like, it will be like a little bit of a hat shape. There will be growth in Q1. Don't get me wrong. There will be growth in Q1, but it will not be, if you expect whatever X percentage average growth during the year, it will be a little bit higher than the average, lower than the average, and Q2 and Q3 will be higher than the average. But there will be growth in Q1.
And one more from my side. So most of the peers in the sector are mostly emphasizing on digital and the percentage of revenues from digital, whereas our strategy has been quite different, talking of more of shrink IT theme, and the new strategy also appears a bit different. So, I mean, within our focused verticals, how is our digital proposition? Are we seeing a larger digital deals? Any view on that? Thanks.
Yeah. See, I actually think that, first of all, we owe it to everyone to deliver performance on our complete portfolio, not just on a slice of our portfolio, right? So while whatever we define as digital is important, the rest is also important. So we are very focused and will continue to remain very focused on performance of our entire portfolio, all of our businesses. How we define digital is helping our customers transform how they interact with their customers. And that portion of the business is doing well across all verticals. We don't kind of report out on what that number is separately, but it is doing well.
Thanks.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. We have the next question from the line of Gaurav Rateria from Morgan Stanley. Please go ahead.
Hi, thanks for taking my question. Kish, congrats on good set of numbers. Two questions. Firstly, if you were to characterize the growth in 2018 from new clients as well as from existing clients versus that of 2017, would it be fair to say that 2018 growth will be led more by from the new clients than in 2017?
Yes and no. So there is what's happening in 2018 is that there is an overhang, which I've spoken about before, from those two clients, right? Which you got to make up for. Which, by the way, we had to make up for those in 2017 too. So, but that full impact was not only in 2017. There is some, there is a roughly similar impact in 2018 of those two, right? So given that, in absolute terms, the contribution of growth from new clients is higher. However, if you normalize for that, then, existing clients, so if you take that away, then there is enough growth coming from existing clients also. It's more balanced if you normalize for that.
All right. Secondly, just wanted to get your take on the overall tax rate cut in the US and potential impact on spends for the vendors. Are you seeing that in your deal pipeline already? And if you could provide some color on how the pipeline looks now versus last year, that will be helpful. Thank you.
Yeah. So, I don't know. Somebody did, I think there has not been an official survey yet on how, if $100 comes, how much is going to go to investors, shareholders versus employees versus be deployed in capital projects. But whatever early indication seems to be that a vast majority will ultimately go to shareholders and not a lot to employees and or to additional spend. But some will go, and whatever comes is positive, net positive. It could be 10%, 15% of the money saved due to tax, but that's all good net new money. Our pipeline, both in total quantity, but also in what is the more important metric for us is the size per deal, continues to look up. Our average size per deal has just never been higher than it is, which then allows us to prioritize, focus on a smaller set of deals and really kind of shed out the smaller deals which could be larger in number. And so it allows us to do that. So our total pipeline is strong, but also then the average size per deal is just stronger than ever it has been.
Thank you. If I can squeeze in one more, Kish, will be helpful to get your take on what's happening on the immigration front. You have been quite right with respect to telling people in terms of what's likely to happen. That has played out. So what's your take now? And do you think companies preparing for trying to change or shift the mix towards more locals rather than depending on visa-based employees? Thank you.
Yeah, I think the shift to a more balanced and a more diverse workforce is anyway an imperative for us, and I think it should be for virtually everyone in our industry. I don't think there is an additional sense of urgency that is required because of visas. I don't believe there is going to be a material change that is imminent. Right? That is my view, our view, that there's nothing that's going to happen. Having said that, there is a process of improving local hires, diversity, before this whole noise around immigration started, and it will continue. Right, just to make sure you understand, I don't think there is going to be like a knee-jerk material change in the immigration policy.
Thank you.
Thank you. Participants, if you have a question, you may enter star and 1. We have the next question from the line of Apurva Prasad from HDFC Securities. Please go ahead.
Hi, thanks for taking my question. Keech, my first question is on your outlook on the top 10 accounts. Is that the one account that you talked about, is that really behind? And how should we really see that going ahead?
Yeah, you should see our top 10 accounts grow without any asterisks or normalizations for one account or anything. I mean, even in this quarter, our top 5, you should think of it as at worst for our top 5. We were flat, which is, by the way, better than our expectations. We expected our top 5 this time will go down. Ultimately, our revenues performance for this quarter is way better than what we expected. We had said close to double-digit Y&Y, which could have meant 9, 9.5, 10, but we were at 12.3. So definitely behind us. You should see, robust performance in our top 10.
Right. And also, if we can talk about, give you some color on the verticals, how should we see that going ahead, particularly the banking, BFS vertical?
BFS for us continues to do very well, right? Including in Q4. At this time, BFS now contributes 44% of company revenue. So I don't see, they will continue to be growing faster than company average for us. And we're seeing, good pockets of demand, continued pockets of demand. The tax that, we spoke about a little bit earlier, I think is only going to help. Some of the tax dollars will flow into some pent-up demand. So it'll improve. I don't know how much percentage of tax dollars will flow into demand, but some will.
Great, that's helpful. And just a couple of quick ones for Rajesh. If you can help me with the ETR for next year and CapEx plan.
CapEx plan will be 15 million next year, and ETR we are estimating around 20.5.
Okay, all right. Thanks and all the best.
Thanks.
Thank you. We have the next question from the line of Ashwin Mehta from Nomura. Please go ahead.
Hi, thanks for the opportunity. Keech, wanted to check in terms of our guidance of 10 to 12% on revenues and earnings. What are the underlying margin expectations? Do we think the margins will still stay flattish, or are we building in some improvement going forward?
Well, I mean, the fact that we are saying revenue and EPS will both grow at the same pace basically means that we are expecting at a PAT level margin for the full year to be flat. Like I said, there are some puts and takes before that. I think we will have slightly lower ETR than last year. We will have, but that will get compensated by likely lower forex gains than we had in 2017. At an EBITDA level, we expect it to be flattish. We do expect to make, which we started in Q4, robust deal signings. Some of these are multi-year deals that we need to make transition investments for up to 6-9 months in some cases. So some of those will be, important factors for margin for 2017. But yet, all of this still means that at a PAT level, we are expecting revenue and EPS to grow parallel to each other.
Okay, fair enough. And second question was in terms of verticals. So the only vertical that doesn't seem to have performed for you was travel and transportation. So how are you seeing growth or the outlook there going forward?
Yeah. So one of the top 5 clients, and in this quarter they were not in top 5. In this quarter they were in the 11 to 20. So the drop in 11 to 20 this quarter was a result of that client. So that client went away essentially effective, H2, right? So you're seeing equal impact you will see equal impact in this year and in 2018. Of course, our guidance for 2018 accounts for that. So I think, for us, after accounting, I mean, if you normalize for that segment or that vertical will grow. But if you account for that, it's going to grow slowly. So it will still be, among the slower growing of verticals, if not the slowest in 2018, because they had that one large account which contributed a significant percentage, and that is an overhang in 2018. So they will grow, but quite a bit slower than company average.
Okay, fair enough. Thanks and all the best.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may enter star and 1. We have the next question from the line of Ashish Chopra from Motilal Oswal Securities Limited. Please go ahead.
Yeah, hi. Thanks for the opportunity. Keech, would it be fair to assume that the impact from the two accounts spread over CY 17 and 18 would be roughly equal, or would it be more in one year versus the other?
Roughly equal.
Okay. Yeah. And just the other thing from my side was, so if you could just share some thoughts on the growth by geographies for CY 18 that you're baking in the guidance, given the significant skew from rest of the world this year, but just how you expect it to pan out.
Sure. So we continue to expect that APAC will lead growth. So we expect the growth rates to be in the following order: APAC, Europe, North America.
Okay, but you expect the difference in growth rates to converge significantly, or it could be mirroring CY17 again?
No, I think CY17 for APAC is it's like 60% growth. It's tough to replicate, but they'll do very well, APAC. But Europe will do better than what they did in 2018. That's our, in 2017. They grew at 12%. We expect them to do better. I don't know what you meant by convergence. So APAC will reduce a little bit from current year. Europe will improve, and North America should stay similar, right? And certainly, relative order will be APAC quite a bit ahead, followed by Europe, and then North America.
Okay, that's it from my side. Thanks and all the best.
Thank you. We have the next question from the line of Shashi Bhushan from Axis Capital. Please go ahead.
Thanks for taking my question and good quarter. Congrats for that. What we have seen in CY17 is higher utilization and some G&A leverage driving margin improvement. What are the margin levers that are left for us? Because where we are operating in terms of utilization is pretty high, 80.8 or 81. So, how we are going to see margin improvement for here, or are we saying that we are comfortable with this range where we are right now?
Yeah. See, first of all, my guidance does not account for margin improvement, right? We're saying that our, EPS and revenue will be parallel growth. So the thesis for value creation is all led by growth. It's not led by profitability improvement. On the contrary, we think there could be unexpected headwinds. I mean, that did happen in 17, for example. We had a rupee appreciation. And so far this year, also at least till last week, the rupee was appreciating again. I think we have levers, but I think those levers, the conservative kind of outlook right up front is that they will go to, dealing with potential headwinds, right? So what are potential headwinds? First, what are levers and what are the potential headwinds? Levers are, I think SG&A will continue to be a leverage. It's a slow burn leverage. As we continue to expand revenue, every year we will get some leverage from SG&A. We're not doing anything deliberate or step function, but there will be a gradual and continuous leverage. But that gradual and continuous is not insubstantial, right? The second one is offshore. So if you see our offshore ratios have started improving, right? We are hoping to continue the journey. That's certainly, a lot of effort and policies in that direction. It does not guarantee to happen each quarter, but that's the second one. And clearly, as we improve our offshore, then, our overall margins will, that's another leverage for it. The third is while utilization is not a lever anymore, but direct cost through other mechanisms continues to be, which is, pyramid and, fresher ratio. We didn't hire a single fresher in 17. Many different factors contributed to that decision, but we didn't hire a single one. Or maybe we hired less than 100, right? But there'll be quite a bit higher in 2018. So I think direct cost, onshore-offshore ratio, SG&A leverage, all three continues to be positive levers for us. Potential headwinds, rupee appreciates again. Continues to appreciate. We had a little bit of pricing headwind in 2017. That's not to be, nobody should get surprised with that level of pricing headwinds. So I think our outcome we expect is to use those levers to manage potential headwinds. If something improves, that's great, but that's not the primary thesis. The primary thesis is to deliver top-line growth.
We had significant headwinds from a few of our top clients you articulated over the last a couple of quarters. Now, most headwinds have played out, right? Partially in this quarter and maybe some in the next quarter as well. Now, coming in CY18, do we expect that most of these headwinds from top client, when it happens, it has their own margin impact. So those headwinds are behind, then we should see some margin improvement just from that as well.
Yeah. So I want to clarify, right? The issues of the clients are fully behind us from a quarter perspective. From a full year, you saw partial year impact in 17. You'll see the other part of the impact in 18. But from a quarter, they're fully behind us. And yes, there are some edges that are not perfect in the quarter. For example, Q4, if that's when they're ramping down, we can't manage costs perfectly well. So there's a little bit of improvement opportunity from the current quarter. Yes.
You talked about pyramid. What would be our 0 to 3 years experience workforce right now?
So not information we report on. In fact, not even something that I know top of my head. Maybe Ashok does, but not something we report on.
And where do we include our cloud and digital revenue? Is it in application development and IMS?
Actually, cloud is there in IMS. A part of it is in IMS. A part of it is in ADM. There is a small part in BI too. So, for example, we implement analytics on the cloud. So that portion is our BI and analytics business. So those are and there is some, in our enterprise services business. We have Workday and Oracle Fusion there, and our Salesforce.com. So it's actually spread across 4 horizontals. The other one, digital, is similar, right? It's digital, in fact, spread across virtually every horizontal. There is some contribution to what we think of as digital.
And we are not disclosing our digital revenues separately. We are not calling it out.
No, because I actually think that until the industry converges on a definition, it's quite meaningless.
Sure, sir. Thanks a lot, and all the best for next calendar year.
Thank you.
Thank you. We have the next question from the line of Sandeep Shah from CIMB. Please go ahead.
Yeah, thanks for the opportunity. Happy New Year to the management, and congratulations on a very good execution despite headwinds. The first question is, Keech, you believe that the deal closures within the markets are improving on a Q-on-Q basis or a couple of quarters back versus what it used to be, where clients are more open in terms of awarding the deals faster as the immigration-related issues are a bit dying out, as well as the tax reforms to some extent may give them a confidence about the cash flows and the earnings visibility going forward?
Yeah. See, I don't think immigration was ever a dampener on deals. Even in the height of immigration debate, and by the way, that noise was far more here than in the US. Really, not even close, right? But even in the height of that debate, there was not a client that I know of that paused to consider the impact of change in immigration on their deal strategy. Not even one. I don't think the concern ever reached that point. So I don't think deal flow has got changed one way or the other due to immigration. Tax, yes, I think some, but tax is more. The impact of tax, I think, will be more in small projects and discretionary work, less so on outsourcing. Outsourcing kind of is meant to save budgets. Tax is going to put additional money, so it will get spent on discretionary. But there is some kind of, I think, there is a little bit of more clarity on the overall regulatory and governance environment. So some of the freezing up that happens due to any government change in the US, that's kind of well behind us at this stage. But I think it's been behind us for some quarters now.
Okay. Just Keech, if you look at when you entered CY17, you had 154 million worth of NN deals, and now you have about $170 million. Plus, you also mentioned that the two clients which you had as issues had likely to have a similar impact in CY17 versus CY18.
Yeah.
And you started a guidance of 10 to 12 for CY17, and you ended with more than 15%. Again, you are starting with 10 to 12% guidance. Is it fair to say that one cannot rule out if there is no unlikely adverse impact, the growth rates has a potential to improve? I'm not asking any kind of direction, asking about the conservatism in the guidance. Do you believe that, are you worried about something which does not give you a confidence? Looking at your track record in CY17 and all the parameters are similar while entering CY18, you can actually execute better than what you have guided.
Well, that will certainly be what everybody in the company is working hard towards, is to do better than what you've said at this point. Like I said earlier, right, I hate to be in a position of kind of having to go back. And right now in our industry, I don't know how many people are giving a full year guidance. Not many, that's for sure. And, those that have been giving have had to backtrack, or, that's not where we want to be, for sure. So I would rather, be on the other, I would rather have an outcome like 2017 than ever be in a situation where we have to say, hey, we are now reducing it from 10 to 12 to whatever it is, right?
Okay.
But we are all working very hard to, see how we can beat this guidance. That's for sure.
Okay. Just one strategic question. If you look at last 2 or 3 years journey, most of your growth has been driven through IMS and BPO. But do you believe that the long-term picture, if you look at 3 to 5 years to scale up, your growth has to be diversified beyond these two services, more in terms of scaling up on the big data analytics, or actually creating growth out of data, which many companies have started doing it? So we don't hear too much on this from the Hexaware, where in the last analyst meet you said that you are also looking to create a separate focus in the enterprise solution to drive the growth on SaaS. So if you can update in terms of where are we on that journey for driving growth beyond IMS and BPO.
Sure. So, there's a lot of questions there, but I'm going to try and give 2-3 important pointers, right? In the analyst meet, we said there are 2 imperatives for sustaining growth. 3 imperatives. We have to sustain pockets where we're doing well, so I won't talk to that. We said we have to fix problem areas, and we called out 3. We said enterprise services. ES is already back to growth, right? It's flat. For after years of going down year on year, we are flat in ES, which is basically it's made the U-turn. MNC is actually back to solid growth. It was growing, but much lower than company average. Right now, you're seeing MNC and professional services together in MNC and others. From Q1 next year and going forward, we'll split the 2. So you will see what I'm talking about. We'll also provide you some back reporting so you can do comparisons. So actually, ES, PS, MNC, where we made investments to turn troubleshoots around, have all started showing good early results. And you will see it in the reporting from Q1 onwards. We also said we want to build new digital services that will get us at least 6% CQGR, right? Or more. I mean, essentially goal is to grow 30-40% year on year. The new strategy that we spoke a little bit about, one part of it in the analyst meet, and to the extent that we have an opportunity to talk more in the coming weeks, I will explain in some detail what we are doing. But I do want to clarify one point, that our growth is not just from IMS and BPO. In absolute dollar terms, our single biggest growth has always come from ADM. ADM has been consistently our third fastest growing horizontal. Given that it's like more than a third of our business in absolute terms, and that's very significant because a lot of our application modernization, which is driven by digital initiatives, API, building for cloud, all of that is, extremely relevant for future services are sitting in that horizontal.
Okay. Fair enough. Just two bookkeeping question. You said one of the clients which had an issue in the travel and transportation, which is now within top 11 to 20. You also said that it has now a negligible revenue, but you said one side of the business, if I'm not wrong, IT services is likely to continue. So that chunk has also shrunk where you believe it is now a negligible size. And second, in terms of your cash payout ratio, can you give us some guidance? How should we build? So you have already given a 8 per share, but for which you believe that FCF to the PAT ratio has to improve dramatically, and what are the efforts to do that? Or we may also consider to leverage the balance sheet.
So let me answer the second one first. Our FCF, we don't need to improve it actually. We have lesser capital spend. We already have lesser capital spend in 17 relative to 16. 16 we had massive capital spend, right? But 17 our FCF is pretty good already. So we don't need to do anything additional. We've built up capital consistently. What we said is that we want to build up capital for acquisitions. We've got to a point where I don't want to build up a lot more. I'm trying to balance between returning it versus still holding capital. So my goal in general is to kind of hold or grow it at a much lower rate than we've grown it in the last year. Last year, every quarter we've grown cash and books substantially. It'll continue to grow based on paying out 8 rupees, but it'll grow slower. And that we want to keep for potential acquisitions. So we don't need to change. We certainly are not going to lever up to pay out a dividend. On the first question, two corrections, one to what I said, one to what you said. What you said, actually, it's not that IT is staying. IT is going away. Some engineering work is staying. So that continues to stay. It's not negligible. It's small. And in future, it will be out of our top 20, but it continues to stay. IT is the one that was much bigger. That's gone out.
Okay. Thanks and all the best.
Thank you. Before we move to the next question, we would like to remind participants to ask a question. You may enter star and 1. We have the next question from the line of Gaurav Ratheria from Morgan Stanley. Please go ahead.
Hey, thanks for the follow-up. Kish, if you could help us understand what the deal sizes you're talking about are in pipeline versus what was your sweet spot earlier, and what's driving this change or this increase in the deal sizes?
Yeah, see, I think what is driving it is simply that it's going to continue to happen for a number of years going forward. Is that, you have to prove, you get to a 5 to 10 million deal size, you show good execution, then I think you can credibly fight in the 10 to 25 deal size. You show some solid execution there, you can credibly fight in a 25 to 50. So I think that's the evolution we are in. I think we are in the cusp of that 25 to 50 being fairly consistent in that deal size range. But we also have some moonshots in 100 plus. And we will continue to have those. Those tend to be more in EN, which by the way we don't disclose. We do disclose material losses, but not necessarily wins in that space. So we'll continue to pursue, moonshot deals in our existing customers because we think we can win. More likely the first win of north of 100 million will come from there. But, in the 25 to 50, I think we're going to be very consistent in being able to compete very effectively for NN clients.
These deals are likely to be in the space of infrastructure management services?
Well, no, I think IMS, BPO, app support, app dev, managed testing. So I think a mixed bag of IT, but there are also BPO deals in that size. Okay. Or larger deals, larger than that size, also BPO deals.
Sure. I'm not sure if there's enough time to talk on this subject, but Kish, I know that you don't disclose the digital as a percentage of overall revenues, but if you can help characterize in each of the service line what's actually new, what's old, what's the percentage of, or what's kind of exposure to the legacy business. Probably IMS and BPS is something where most of the business is new because that's where you started that's when you started targeting the deals.
Yeah, I will try and do it real quick for everybody's benefit. So biggest business is ADM. We don't have a lot of support, fortunately. We have some. We don't have a lot. So a lot of it is dev work, which is all now 80% is agile. 70-80% of dev work we do, new work we take on is on agile. And that will continue. Whatever is remaining in non-agile will go to agile. The new wave of change that will start there is that we'll start building for cloud rather than building to be deployed in the in-house data centers and then trying to see how to deploy it in cloud. I think it'll be building for cloud is the future. Building using cloud components and APIs is the future. In testing, I think a very substantial portion has moved away from manual testing. There's still some, but a good chunk has moved into automated testing. There is a new portfolio of services surrounding digital, which is usability testing, performance testing, security testing. Those are our new services. Those are small, but obviously faster growing than the rest of the portfolio. There's still change to be made. There is still some manual testing, but it will go away pretty quickly. But we've been managing through that and still growing. If you see our numbers, our digital assurance, our testing business grew at 13.3% for the year. And everything I told you has been true through 2017, right? There is a portion of manual testing business that we've managed out into automated testing, and through all that we've delivered close to company average growth. BI and analytics, there is a portion which we think there's a portion which is BI, which we originally thought is going to go away more rapidly than it actually has. In truth, it's going to be there for a while. I think the concept that ETL work is going to get fully automated is perhaps a little overhyped. So we think a lot of what one could think of as legacy BI business, the churn is going to be slower. It's going to stay. And then obviously we have the new business in building big data systems and using it for analytics as the newer digital services that are faster growing. The ES is the last service line outside IMS and BPO, where the legacy business is PeopleSoft and some other, in on-prem SAP and Oracle. The new stuff is in Oracle. There's Oracle Fusion, Workday, SAP HANA. So everything moving to cloud, SaaS, Salesforce.com, and the whole ecosystem surrounding Salesforce now, Einstein, Lightning, all of that, and that I think is more than made the U-turn, right? I think the legacy business is now a minority of the total business, and that's kind of then also coinciding with the fact that you're seeing finally year's business coming to flat, and you should expect to see growth in future. I will do one more question. I did say in the beginning we can go for, I'll do one more, but there is not. So wonderful. Thank you all for your patience. I know we went over a little bit. Thank you all and look forward to talking to you again next quarter.
Thank you, gentlemen. Ladies and gentlemen, on behalf of Hexaware Technologies Limited, that concludes this conference call. Thank you for joining us, and you may now disconnect your lines. Thank you.